Hello, this is Jim Riggio. Today is July 17th, 2017, and this is the Monday Market Muse, where we end up reviewing market analysis, take a look at where the markets are, technical analysis, overall market sentiment. But before we get started, a quick disclaimer. Capital Discussion is not a broker-dealer or investment advisor. The presentation you're about to see is for educational purposes only. We have no way of knowing your situation or what level of risk is appropriate for you, and we're not recommending any trades. The risk of trading options is substantial, so please be aware of all risk prior to placing any trades. Any trades that we discuss are computer simulated and believed to be accurate. However, due to such factors as liquidity, slippage, and commissions, your profit and loss will vary. Okay, what a difference a day makes. It is really quite something to see how the markets ended up moving rather substantially. When we ended up speaking last week on Monday, we were in the morning and we were challenging a 2-week or better than a 2-week downward channel. We were saved by the bell a couple of times over here. You can see on the downside. We tried to end up puncturing through a few times, but could not get through. And on Monday morning last week, we were here. I was very fearful that if we weren't able to end up holding above the downward channel red line, that things looked rather dire for the market. You can end up seeing on Tuesday there was a sell-off, but there was a reversal. But from that time, when we ended up having this reversal around 2409, 2410 on the S&P futures, which equated to about 2406 level on the S&P, meaning the SPX. We bounced off of that and have been basically running like a scolded cat ever since, straight up. On Wednesday, when we ended up having this gap not only took us away from the downward trending channel, but as you'll see, it ended up breaking some other rather significant resistance lines. Let's go and take a quick look at that. By the way, today's going to end up being an abbreviated session. I have a flight to catch this afternoon, and I have some things to end up prepare. So we're probably only going to be going about half an hour today. So if you do have questions or want to dial in, please do so throughout the session. I'd like to try to end up answering them as I'm going through everything. If I take a look at the channels that were formed a year and a half ago at the end of 2015, beginning of 2016, one of the things that we talked about is that ever since we got above the 2300, 2350 or so level earlier this year, we've been floating and playing with the upper long-term channel. Right, rather significant. You can end up seeing these particular levels. I've mentioned this before, but it's definitely noteworthy because I get asked many times how I end up drawing these channels. When you start to end up thinking about how we end up doing this, you'll end up pretty much doing the exact same thing that I end up doing. Paul Demers and I have been doing this so long that, when we do end up talking, Paul, what would you say? Probably about 99% of the time, our lines are drawn usually within a few pennies of one another. And so let me just talk real quick about support lines and channels. Let's start with channels. The way I'll end up drawing a channel is that once I can end up seeing something clearly that has multiple points, okay, where we have resistance on the top and support on the bottom. Of course, there will be areas that end up breaking. You can't end up drawing a channel perfectly. You draw a channel. This channel was drawn before the election last year. So when we ended up drawing this channel, you can end up seeing here clearly that we ended up having multiple times on the top where we tried to end up getting above. I ended up using this channel where I ended up drawing this bottom point. I didn't use this because I'd rather have a narrower channel. If you make your channel too wide, they're really I don't want to say useless, but they're less useful is probably a lot fairer way of saying it. So we ended up having this. So it wasn't any surprise that when we ended up having the sell-off going into the election, that this channel was there and ended up holding. You can end up seeing that as we ended up running up, it had been a bounce several times. It wasn't until we got to the breakout in February where we got above the channel. When I draw significant lines that are support or resistance lines, those are the yellow lines that go across. Upward channels are blue. Okay, support and resistance lines are blue. On this one, I will not end up having individual support or resistance lines unless they are the ones that are significant. The ones that are significant are the ones that are in play. So I'll end up taking it from the next chart that I'm going to end up showing you. And you can see that this green line here was the support line that worked just perfectly and was able to be drawn in January, February, and as we ended up having a breakout, you can see it's really acted as a pivot line where we've struggled to try to get above it, try to get below it. You will notice that the green line down here didn't end up appearing to be nearly as strong as the long-term channel, but you can end up seeing, obviously, as we've come to this month, that the support line that had been support and then turned into resistance several times, it has a steeper lower left to upper right slope than the channel ended up having. So it is now the overhead resistance, even though we are busting through or have busted through the longer term blue channel. So when I end up highlighting just this, and let me do this so that it's a little bit easier to see. Let me come and try to draw it this way. Let me come. Okay, this will end up highlighting it, making it a little bit bigger to see and I think easier. So one of the things that you can end up seeing is that when we had that gap from Tuesday into Wednesday, and you can see this gap here, I want you to end up noticing that we gapped straight through the simple 20-day moving average. The 20-day moving average tends to end up being a line that a lot of institutional traders or investors will end up using, and hence the algos and the high frequency guys all know that. So what you'll end up seeing is that many times they're not going to end up attacking the 20-day moving average unless they have ammunition to try to end up getting through. You can end up seeing, examples over here. I mean, there's just so many of them. Once we ended up attacking the 20-day, we got through it, okay, and we were below over here. You can also see this trend line just acted perfectly with it. When they ended up attacking the 20-day, they ended up having a gap and they busted straight through it and they ran up. Well, the same thing ended up happening. How did the sell-off happen? We gapped below the 20-day for the open and then we drove lower. And so you can end up seeing how important the 20-day is. Now, is it that the 20-day just works so well, or is it that every institution, high-frequency algo trader, and any retail trader who's traded for any period of time realize how important it is, and everybody looks at it and uses it? I think that they are probably more self-fulfilling prophecies than anything else, and when other things start to end up working better, they end up jumping on the other side. And so those are things that you'll end up seeing that will end up going through for the way things end up working, okay? And so that movement back through the 20-day is something that I'd end up expecting, but usually when you end up having a breakthrough on it, you can see here, okay, that we end up having a breakthrough. You do get some movement, but you tend to end up coming back to it in some period of time. Sometimes it's a few days, a week. Other times may stay on one side of it for some period of time, but it does tend to end up being somewhat of a magnet. So hence the slope of the 20-day is absolutely critical. You can see that when we broke through this, we were in a downward trend, and during these few weeks, we had a downward slope because the 20-day was, obviously higher here than it was here. And in the shorter term graph that I had showed you previously, during that period of time, 2 months ago, 3 months ago, we had this downward channel. Well, we had the same downward channel here, okay, during this 2-week period, and you saw that on the previous graph. I'll bring it up in another minute. And so not only did we break through that downward channel with this gap, we broke through the 20-day, and we broke through a very, very important support level of 2040. When we moved up to 2040, and you'll end up seeing this. Now remember that the S&P is slightly different than the SPX is slightly different than the S&P 500s. So, for example, right now, the SPX is at 2461, and the E-minis are at 2459. So there's about a 3-point difference. That 3-point difference will gradually dissipate and go to zero as we come towards the E-minis expiration. Which is in September. The difference, just so that you guys know, it's basically the difference between the dividend and the risk-free rate. When the dividend is more expensive than the risk-free rate, the SPX will be higher than the futures. If, and you have to go back a while in history for this one to end up happening, if the risk-free rate, meaning the treasuries for 3 months, right? Because there's each one of these things ends up moving. Each one of these, meaning the S&P futures, is for 3 months for when it's the active contract. If the 3-month treasuries are higher than the dividend, then you would see the reverse happen. So it's basically just a play in interest rates. It's not arbitrary, right? You can't arb it. If it ever got out of sync in any way, shape, or form, the high frequency and the algo guys would end up pounding it to death, and until it was in submission and it moved back into perfect alignment. So you can end up seeing here, like I said, that we definitely have some support. You can see the run-up that we ended up having on Friday afternoon moved above the channel line that we ended up, I'm sorry, not the channel line, the support line that was formed during this period in January and February. And it held. It held, and we came back down, and we moved. And so these particular lines, like, I'm not the only one in the world who sees these. As you learn to end up drawing these things more accurately, and as we review them every single Monday, you'll see that they are more important to the algo and the high frequency guys than many of the other things, such as the oscillators, the MACDs, the stochastics, the RSIs, and also the momentum indicators. And so when we take a look at this jump and where we ended up moving, there was one other thing I wanted to end up showing on the previous draft before we go into drawing all of the charts. And let me show you that. I do this on the daily chart, and what you end up seeing here, you guys can end up doing this at home if you want. I end up always wanting to see the daily ranges. So the bottom of the daily range is in orange. The top of the daily range is in blue. As soon as I see a defined channel, I'll end up drawing it. When there are key points, I will end up putting circles in them. You can end up seeing here that I drew a circle in and around once we ended up breaking the support, and we went right to this white line. Okay, you can see that when we ended up breaking down here, this was a key level, because if we kept breaking down, okay, I was fearful that we could end up really seeing a market sell-off. The same thing over here. What I ended up stating was that if we ended up breaking through this low. So on Tuesday, I ended up writing for all the Vantage subscribers last week that if we end up breaking this low, we could see significant selling. Well, we did, but we went right down to that 2406 level, right, on Tuesday. So if I flip back to this, if I show you where we ended up coming down on last Tuesday, we ended up coming down to 2412. Okay, I added, not subtracted, so I'm sorry. But what ended up holding here? Okay, what ended up holding was the 50-day moving average. You can end up seeing that anytime we've started to have any type of sell-off over the last few months, that the 20-day is important and we're trading around it, But the 50-day is where the real support levels have been, and when we've broken through things, that's been a pivot point. I'll end up drawing the 100 and the 150 when they're appropriate. They're not right now, so it just clogs up the chart. So the only thing I'll keep on my chart all the time on this one is the 20, 50, and 200. Look at how smooth the 200 is. If I go back to automate this, and I show you, look at how nice the 200 is, and the upward slope of that 200. That is just an incredibly strong rally. One of the things that you can end up taking a look at is how strong a rally is the slope or the direction of the 200. And that is pretty steep. The other way you can end up taking a look at how strong a market is if I end up showing you the following. Let me come over and take a look at long-term channels. Okay, what I've done in long-term channels, because of the way Thinkorswim is, I'm using the SPY, not the SPX. But what I wanted to end up showing you is a point that Andrew's pointed out a few times is it's not been since November of last year since the market has had a lower monthly low of the previous month. And look again how right here that support level, and again the support level was around 2400, 2406 on the SPX. You can see it was around 240, maybe a couple of pennies above 240, and it didn't even, it tried to get close to it, but it couldn't. And we're just living on that monthly upward channel. So it really has been an incredibly strong market. And whenever the bears have had any short-term opportunity to make headway, going back to the daily channel, looking at the SPX, whenever the bears have had any type of downward channel where they've started to get at least some momentum over a couple of weeks, the bulls step in this type of fashion, in a big, big way where they move just straight up. Now, I had mentioned that the white line ended up holding here. You can end up seeing that we never got close to it. When we ended up moving up last week, look at how the white line, the upper white line, ended up being resistance. You'll notice that each week, like last week, I'm just going to highlight last week into this week. You can see over here that, and I'm going to have to end up just squeezing a little bit. So you can see here was the center white line, here was the upper white line, and here was the lower white line. How do I draw these things? I've been asked for people who've seen this. It is just Friday's close. That's the center line. What I end up doing is that I draw an upper and a lower line based on the expected move of the S&P. How do I end up determining the expected move? Well, I don't end up determining it. I let the market end up telling me what it ends up expecting. How do we end up seeing that? What we end up doing is, let me pull up another chart. I need to get an analysis graph over here. Let me just attach. Sorry, I didn't have this one ready. I probably should have. Okay. Let me come over to here. Okay, now I got it. Okay. What I do each Friday is that I look 1 week out. I look at the following Friday. So last Friday was the 14th, which means this coming Friday would be the 21st. So what I end up doing is that I look at the 21st. Now, you notice that there are two 21sts here. You need to be able to see what the difference is. This is the 21st for the monthly contracts. When Thinkorswim doesn't have anything listed over here, that means it's the monthly contracts. The weekly contracts are clearly labeled. Your broker-dealer would end up doing it a little bit differently. However they do it, you have to end up realizing their format. If you're not sure, or if you ever get confused which one is which, well, Thinkorswim ends up putting it here, but they also put how many days to expiration. Notice that they put 3 days to expiration and the expiration date is the 21st for the monthly, and they put 4 days to expiration, and the 21st is the expiration for the weekly. What's the difference? Well, we all know that the monthlies are the opening print. So what Thinkorswim is that they say you only have 3 more days left to trade it, because after Thursday's market close, you can't trade on Friday's open because it expires on the opening print. So you can end up seeing, this is the weekly. So I want to end up seeing what would be the expected move between now, meaning from last Friday to this coming Friday. It shows the implied volatility off here on the right-hand side, but it also ends up showing what it would end up being in terms of points. Now, remember, implied volatility is the great equalizer. We'd like to end up measuring implied volatility in a standardized way. So it is always an annualized number. Remember what implied volatility means. If we take the price of the options, okay, based on that expiration. Now, the way Thinkorswim figures which options do they end up taking on it, they use the same formula that the SIBO has defined for the VIX. And you can end up reading, okay, on the white papers on the VIX, and you can end up seeing. But it takes, the more common, more traded, closer to the money type options are more important than the way, way, way out of the money options. And so you'll take a look at the implied volatility. And this is the implied volatility, but it's stated in an annualized terms. Don't forget the way it's stated in annualized terms. What it is saying is that at the current pricing of the options that are going to be included in the calculations that are closer to the money, the market is expecting an 8.37% move for the next year. Okay, what is it expecting? It's expecting with what they would end up calling one confidence level or one standard deviation. So this is a one standard deviation calculation, both up and down. It does not have any bias either up or down. And so what Thinkorswim and what most brokers will end up doing is that they'll end up then, because this has been normalized to a year, they will then end up applying the same formula using whichever model. Okay, you end up having Black-Scholes or whatever, and they'll end up having, this is how many points up or down they think that the market will end up moving. Well, up or down on Friday was about 24 points, and so what I ended up doing in terms of drawing these lines, I had my center line here at 24.56 and a quarter, and I added my whatever it was, 24 points and a quarter. But I added them and got the upper line, and I subtracted them, and I got the lower line. Here's what I wanted to really end up showing you on both Tuesday and Wednesday with that move. Look at how when we ended up gapping up, that the expected move line really ended up, it loomed overhead for a large period of time. Even on the next morning, on Thursday morning, we moved up, we came off of it, and when we ended up traveling through this line, I mean, they really tried to end up battling pretty much to the end of the day, where they finished pretty much right on it. It wasn't until Friday when they tried to break above it, and you can see that it came down a couple times, but once they moved away from it, it kind of sprang and it really moved forward. So these expected moves are critical. One of the reasons why they end up working so well, let me take one step back. Just because some indicator seems to end up working or not working doesn't mean that you should end up using it. My favorite example of that, some people used to end up, who've been in the market a long time, in the 50s and 60s and 70s, used to end up saying the fashion, in fashion, the length of a woman's skirt, if it went up or if it went down each year, was a predictor of the market. Then football fans, okay, through, I'd say, the late 80s, excuse me, or so, used to end up saying if the NFC won, the market would go up, and if then they end up changing a little bit. If the original NFL teams ended up winning the Super Bowl, the market would go up. I mean, and they were just all nonsense. But the biggest nonsense one of all, and this one was my favorite. I don't know, some analyst had way too much time on their hand. He ended up analyzing the price of every commodity, every index, every currency, and every cash-based price that he could find of any commodity around the world. And in the whatever he ended up doing, I think it was the 3 years leading up to the financial crisis and the collapse of the markets in mid 2008, because if you remember, we kind of sold off from late 2007. The product, the index, the commodity, or the stock index that ended up predicting the collapse the most was the price of butter in Bangladesh. I mean, there couldn't be a more nonsensical type of indicator. And so one of the things that I do end up taking a look at, I explain that the 20-day moving average is important because a lot of people end up looking at it. The daily ranges are important because when you do break through a daily range, you're into a new territory. Why do the weekly expected moves work so well? Well, one of the things that had happened after 2008 with Dodd-Frank being both turned into law, and it was very, I'm going to use the word nebulous in terms of the rules and the specific rules that needed to end up being used. And it wasn't until it was implemented a couple of years after where banks weren't allowed to end up using as much leverage. They were not allowed to end up trading and taking a risk capital on their balance sheets, and they have to end up reporting on a weekly basis. And so what ends up happening is that if they sell any options, they're usually going to sell them a standard deviation out or more, and they're going to have to end up covering when they end up getting beyond that. So what happens many, many, many times is that you'll see the markets move up to the weekly expected move, and then the large institutions will drive it back down. If they do not drive it back down because the market forces are so strong in taking it in the directions that it's going, you'll normally see a break away from that expected move. Okay, very, very important. Okay, and so I feel that it's so important that I draw them every single Monday. I put them out. I end up showing them, and I keep them on this. And when I do my daily morning update, which I do every morning for my Kevlar subscribers, and I do this presentation in like a full hour for them over the weekend, but I go through a lot more graphs. You can end up seeing, the thing I want you to end up noticing about this week's expected move is look at how much narrower it is than the previous week. Why does it get narrow? It gets narrow because volatility goes down, meaning expected volatility or the VIX. Let me end up showing you the following. No, that's not the one that I wanted to show. I think, is that it? By the way, this just shows that the skew, this is an important one, and while I have it up, I'll just mention it. This ends up showing the skew. What the skew is, it's a SIBO index that only has an end-of-day print. Hence, you see the dots. You don't see candles here, right? And then I ended up putting the 50-day and the 200-day, 50 in yellow, 200, to be able to show that how the skew has gotten steeper over the years. You can see that in the 50, as we move, every time we end up establishing a new levels of highs, they'll end up being higher than the previous one. And you can see that the 200, while it oscillates, it's clearly on an upward path also. Why does that end up happening? Again, Dodd-Frank said that the banks couldn't leverage themselves as much, hence they didn't give their hedge funds and institutional clients the same level of margin. And how do you end up controlling your margin? Okay, if you're a big hedge fund, you buy way out of the money puts. You know it's a cost of business. They're throwaways almost all the time, but now you can end up trading. So if you own all of these out of the money puts, they're the ones, like the 10% below the money type of stuff that goes into calculating the skew. And so as more and more high-frequency traders got on the same page, how they ended up working, you'll see this move, and it really is a new environment. So in my mind, testing now is really difficult because the way the market moves now really isn't the same as the way it moved, let's say, from before 2013. Um, it just isn't. It moves much faster, implied volatility, but yet since 2013, you don't have any significant pullback that can end up showing you what things look like. The reason why you heard Paul clear his throat was that usually I end up bringing up, okay, what happened last August, where the VIX just spiked unbelievably, and many people couldn't believe, and a lot of normal trades got hurt in that. Let me show you real quick, and then Paul, I'll let you add. Just let me bring this one thing up.
Well, I was just going to make a comment like, had I known back in 2013 that they were going to be the good old days, I might have traded more.
Okay. Here's what I want you to end up seeing. On the left-hand side is the VIX, okay, and the VIX is in yellow, okay. Again, what I left here was the skew number, and instead of putting dots, I just have a line up days and down days in red and green. You can see this. But what I want you to end up seeing is that we have made a multi-year low on Thursday. We got to 9.9. A matter of fact, this chart, you can see, goes back since the skew was invented by the SIBO. And since the skew was invented, only goes back to 2011. Goes back to 2010. We have never hit a VIX this low. I have to take the skew out and go back, many years to, the early 2000s to end up seeing what this ends up looking like. Now, what I do want to end up pointing out is look at how the skew, right, this is line, has gotten steeper. So even though the at the money, okay, puts and calls have really dropped, what it's telling you is that the out of the money protection, the far below the money protection, is relatively expensive to the 9.5 VIX that we end up having. The point that I wanted to end up showing you last August, and this is where we ended up talking, is that look at what ended up happening and where the VIX got to, right? It's this line. It's on the left-hand side. In a very, very few number of days, in less than a week, okay, the VIX went from 12.7 up to over 40, okay? That level of vicious, okay, move higher ended up just causing huge amounts of issues in a lot of trades, because not only were most trades negative as you got thrown out of the back of your butterflies or whatever trades you end up putting on, but the increase in volatility ended up hurting. Remember, I've used this line many times. Almost every market beating I've ever taken, the two thugs that beat me up were the gamma, the continued move of my trade, and the vega. Because most of our trades, if you're going to try to end up collecting theta, okay, usually, okay, almost always, really always. The price that you end up paying is that it's gamma risk, the price that the market may continue to end up moving. And so that's the biggest problem. Paul, the floor is yours. I know that you have a lot of scars from that day.
Yeah. Well, it's, of course, the interesting thing is, I was watching the internet and everybody was talking about, we hit a low in the VIX. And I went back and looked, and according to Yahoo Finance, Friday was not the lowest the VIX ever closed. There were 2 days that closed lower in 1993. So maybe their charts didn't go back that far. But it is unbelievably low.
What I want you to know is that when people do those types of index comparisons, you need to know two incredibly important facts. Number one, okay, several years back when weeklies became prevalent, the SIBO put an update to the way they calculated the VIX, because when the weeklies first came out, they did not include them. After they got to a certain level of volume and liquidity that the SIBO deemed appropriate, they then changed their VIX formula to end up including them. That's number one. What was even more significant is for the majority of the VIX life, it was not on the S&P 500. It was on the most traded large index options in the world. And for many, many, many years, that was the S&P 100, not the S&P 500. As we changed to larger contract sizes and more computer-based trading, even now, if you go and take a look at the SIBO, if you ever go to the floor, there are plenty of people who are still standing in the SPX pit. Matter of fact, the only two pits that people are even trading in anymore are the SPX and the VIX pit. The old OEX pit and XEO, that was the S&P 500. They looked like a ghost town with tumbleweeds blowing through them. Years ago. Before everything ended up, because nobody traded, everybody moved over. So while this looks low, it's the way that Thinkorswim ends up calculating. If you end up going back, and I only go back 20 years, right?
Right. That's why probably people are saying that. Now, when they started including the weeklies, my guess, because I don't know for sure, but a lot of people hedge their trades now with very short-term weeklies. So there's a lot of put buying going on and selling, and there's a lot of activity down there, which will affect the 30-day volatility more so than the 30-day would. I don't know. Maybe I'm wrong.
No, you're definitely right, and it'll be the institutional people who or the retail people who are just looking to end up, protecting their portfolio. What you won't see is the high frequency and the algo guys, what they're buying. Why? Because they know what, as anybody could know who spends time and actually reads through, all of the SIBO papers. They know if they buy this put, it's going to be calculated in the VIX, but if they buy that put, it won't be calculated in the VIX. So one of the things that you'll end up see them doing is that when they're trying to end up doing any type of arbitrage or plays on the VIX futures, the VIX options, which are priced on the VIX futures, or any of the VIX-based ETFs or ETNs, they know how to end up playing this, right? They've been the level of sophistication that they end up doing truly is rocket science. And so you see the low that we end up seeing now. This is a monthly low, right? Because I looked at a monthly chart here just so that you can see all the way back to 1997. If I end up going and taking a look at the weekly, I don't think the entire weekly chart can get all 20 years in it. Oh, it can. Okay, so here you can see that the weekly low, and the weekly low was Friday's low. So the weekly low was the same as the daily low.
So, of course, I think the other thing, too, is some of the money managers that can do it, they're also, I think there's a lot of people now using the volatility products for hedges and also the futures. So, are less people involved in the option market for the hedging and the fear than there used to be.
It's a very, very good point. That's why when I end up doing this on a daily basis for the VolVantage subscribers, what I end up looking at, and I will end up posting many times, is that fear level in such things as the VIX futures. The VIX futures, not just for this month and next month, but going out in terms of the term structure. I'll also end up looking at what the cost of the VIX options are. Remember, the cost of the VIX options are the VVIX. Now, this is the implied volatility for the puts and calls on the VIX options. And you can see, yes, we're low. There's no question we're low, but we're not at a multi-year low. So the VIX has been driven lower, right? Has been driven lower than the level of complicity or complacency, I should say. I'm sorry. I guess they trade together, so it's complicity also. But I meant complacency in terms of how much people are willing to end up paying for VIX-based options. And remember, usually it's going to be the more sophisticated investors, the hedge fund managers, the hedgers that are going to end up using these options. And yes, while it's low, we're not at this multi-year low. The other thing that I'll just note real quick is that when I take a look at the VIX term structure, because to me this kind of ends up telling the tale. You can end up seeing that how the front month VIX future has kind of mirrored the VIX and how it's moved down. But you can see that the longer term, which you kind of would expect, has come down. And this is a very normalized type of a curve. But look at how much wider. Look at how much wider the 1 and 2 month. This is the front month. Okay, for those of you who haven't seen this, aqua is the front month. You can end up seeing that right here. And so that's the front month, which is the August contract now. And each month going through the colors of the rainbow, well, as close as I could get them, is the following month. So you're looking at August, September, October, November, December. And what you like to end up seeing when you end up having a pretty significant movement, if I show you this in a longer term, right now you're only looking at 20 days on 15 minutes, but if I end up showing this over a long term, you like to end up seeing this nice downward movement. Now we had the couple of spikes in here and things started to end up bouncing up, but you can see that especially since we ended up having the market rally last week, just how everything kind of got back into a normal contango pattern. Now this is extremely wide, and many times what will happen is that when you get extremely wide, you do end up having significant days. And here's what I wanted to point out to you. Look at how quickly this you can end up seeing the spikes in the VIX. This is what happens now. Okay, now this was a one-day spike because the selling didn't continue. What I wanted to end up showing you is that if I end up going back to and can I go back further here?
I'm going to take a look in April.
Yeah, I wanted to. Give me 1 second.
Sorry.
Let me go. I'm going to go there, but I'm only looking at April.
Didn't mean to commit.
Here's what I wanted to end up showing you. This was a one-day spike, but look at what happens if it continues. Okay, we got up to 16 or 17, but then look at what can happen in 2 days. You can go from 16 to a high of 53 very quickly. Now, even that, okay, with the whole fear about currency in China and everything else that ended up driving this, it only lasted a couple of days and it ended. And so it really will end up being news-driven, and it doesn't take much news. Now, this was nothing, right? Nobody even remembers what ended up happening here. You have to go back and say, I don't remember. You have to go back and look in history. It's not like you don't remember what happened during, say, 2008. If I go back a longer period of time so that you can end up seeing this, and you take a look at what happened during that time, okay, and I come back to that 2008 time frame, look at what ended up happening, okay, here. We got up to the mid-90s, almost 90, and we stayed at an elevated level for a long period of time. Many people will remember how difficult 2011 was, okay, when we ended up trading. And this was during the period where we had the debt crisis. Do you remember that Congress ended up? They waited till the 11th hour and 59th minute to pass the resolution that said yes, the U.S. government should pay our debt because we were at the debt ceiling, and this was all kinds of political, fear, and we jumped incredibly high and we stayed up here, and this was significant. I mean, this was really, really significant, and we reached 47, and we stayed up in this area for a while. On I'm going to call it the almost nothing news in retrospect about what was going on in China, we got up to 53. We had a higher implied volatility, okay, in 2015 than we had in 2011. I mean, I don't get that. I mean, this was nothing. And so this is a glimpse into the type of market wreckage you're going to see when we have a real sell-off. And all of the back testing in the world will not tell you just how bad the spike in the volatility is going to get when we do have a real bear market. So what ends up happening is that at the slightest little fear, okay, you end up seeing the VIX and the VIX futures spike dramatically. Okay, most of the times, every time, a matter of fact, since 2011, within a couple of days to a week, okay, everything passed. And that time since everything passed has been getting shorter and shorter and shorter. And so, Paul, you and I have talked about this, how modeling and understanding how your trades actually work is so much important than looking at somebody's back-tested data, in 2011 or in 2006. It just doesn't make as much difference. They need to be modeled properly.
Right, and even then, all you can do is you're modeling on the past. You don't see what's really going to happen this time. But it's you've talked about this before, Jim. When you're back testing and you're trading once a month, and you only have 12 instances every year of the trade, and you don't really see everything. And my suggestion to anybody that does back testing is to take these environments where the vols spike up like this and put the trade on 3 days before, 2 days before, the day before. Put a trade on so it'll end when that spikes, or in the middle of the trade. So you see how it reacts to these different environments that we're witnessing.
Oh, and Paul, that is so critical because, listen to what he said, okay? And Paul, explain why it's so important not to end up just back testing your trade every single time at 53 days, but why it's important to end up moving it, earlier and later because of those spikes.
Right. Well, the dynamics of the trade, a couple of things. You may not have an instance if you're putting it on and just back testing it like, my trade starts around 63 DTE. So you might not have this type of environment show up right off the bat. You might not put yourself in a position to see how the trade is going to morph at different times when you get the vol spike. So it gives you a little better indication, I think, of how the structure reacts to different moves. And it makes it easier now with the weeklies, back I've started with you, it's tough to do because you really only had monthly trades to backtest, monthly expirations. So now you can find a 63 DTE trade, every couple of weeks. So you can get something, you can put trades on at different time frames so you get this. I think it's very important because it's opened my eyes up to some of the trades and to why I buy a put right off, especially when the vols are this low, because I've tested how tough it is for these trades when you get a 50% spike in the VIX, in the first week of the trade.
Well, even though implied volatility below the money is so much more expensive than compared at the money. You saw that with the skew. Okay, there's a reason why that ends up happening, and the reason why that ends up happening is, of course, because of margin, but also, okay, why do they end up buying them where they end up buying them is because if you end up having a spike on the VIX from a 13 to a 40 in a matter of 3 or 4 days, it's really not that important that they charge you an extra, 25 cents or dollar, even $2, okay, for the option when it ends up going. Now, the problem is if you don't spike over time, that becomes very expensive. Just the way Paul ends up buying puts when the markets start to end up going down. What will end up happening is that many times you guys are going to get frustrated with them because I don't know, Paul, probably 19 times out of 20 you're going to end up losing money on that put. Why did you buy it after it got more expensive? Or you could have bought it beforehand. But in that one environment where the VIX does go to 53, okay, you'll be very, very thankful for it. Now, one of the challenges that you end up having when you're buying these puts, or you're buying a VIX call spread, like I do sometimes to end up hedging, is that there's much skill in when you take your profits of that. The great thing about the way Paul hedges the Jeep, or the way I end up hedging the Kevlar, or the way I'll end up using the VIX verticals to end up hedging, is that you need to be able to harvest your profits on your hedge, because if the market bounces right back up, all of the profits that you did have on your hedge will end up getting destroyed. Now, you also have to end up being careful, right? If you take off your hedge completely and the market continues to tank, if you take it off too early, you can still get hurt really badly, but at least you made a big chunk of money on it. So that's where, quite frankly, all of the testing rules in the world, they don't matter, because the thing is that you don't have enough sample sets to see what the market would actually end up doing. And in the handful of sample sets you do, the way the high frequency and the algos trade today, trying to use the volatility spikes in 2008 or in the dot-com bust, okay, going back to 2000, I don't want to say they're meaningless, but they're much, much less effective in giving you an idea of the way the market's going to end up moving. So you really do have to kind of end up playing the what-if analysis to see how bad things could potentially get.
That's true. Yeah, I think at that, you back test it to see how the trade reacts, so you get some kind of idea what to do. But when it happens, you're going to have to. There's kind of a seat of your pants thing of how you handle it, and you can't have a plan, because it's going to be different the next time than it was the last time.
You want to give him Mike Tyson's quote?
Everybody's got a plan till they get punched in the mouth.
That's exactly it. Right. So
and I've been punched in the mouth just a couple of times.
Yeah, it's I'm going to start to end up using you as an example. I only used to use Dan Harvey, but I used to end up saying that Dan Harvey and I, when we talk about these things, Dan Harvey and I have lost money in new and innovative ways that you guys haven't even thought about yet, because we have seen, so much in terms of what goes on in the market and how just unbelievably ugly things can end up getting. Right. So
even after all of this time, I'm not sure I've lost money in more ways than I think I've got a ways to go yet, and that's what keeps me trading conservative and a little scared. I don't think that's I trade scared, and I try and do it with some balance. But I'm very protective of my portfolio. And I think most people that I talk to are in the same boat. So, we make less money than we could if we were a little more aggressive. But I'm okay with that, because, my trade, I've been double whammy. So I have my trade on. I bought a put. Now I bought a call, and now I'm kind of sitting there in limbo land. But and I paid the typical example. I paid the premium for the put because that was the day the vol spiked 50%.
Right.
But what are you going to do? I mean, the market reversed, so you look kind of stupid.
Well,
but the market could have kept going down, and then I would have been a hero.
That's exactly right. When I ended up putting, and let me just point out, if I come to the daily channels, I left my Kevlars, okay, very negative delta, because instead of hedging, Paul, as you know, what I end up doing is I prefer to end up leaving my structure, my Kevlar structures, to be more negative delta than most other strategies, and that is my built-in hedge with the Kevlar. Because it gives me, when we have these vol spikes and these drops for a day or two, it usually ends up pulling me into my zone. And usually when it gets pulled into my zone, if things don't look so bad, I'll actually then have profits adjust and then put on or structure my trade. So now I'm having it on at a much higher implied volatility. And when you put on a butterfly, a condor, a Jeep, or whatever, having a much higher implied volatility makes it much cheaper. So I have a very cheap one on with profits already in the bank, and I usually love that. But during this period right here, I thought, I was so fearful that we would end up continuing to sell off that I didn't end up adjusting upward. So, I look really foolish now because, look, you had your trades, they were positive, and now they're negative. Well, when we have this type of market and you have the potential fear for the way markets can end up dropping, you have to be respectful of this. One of the things when it comes to, my historical performance in the Kevlar, when most people have taken some pretty big hits because the markets have dropped and volatility has spiked, I love those things because, I'm playing in the center of my butterfly on those days. And I've had some of my biggest profits when other people have had challenges. I know that the way you end up have modified the Jeep, the way we originally changed it, is that you do end up taking the risk out of the trade, but by buying those puts, buying those calls. And yes, most of the times people are going to end up saying, you looked foolish, why'd you buy that? But all it takes is 1 out of 5, 1 out of 10, sometimes 1 out of 20. When they were like, oh, my God, thank God you ended up losing a little bit of money the 19 times before this. You really saved our bacon when you end up buying it. And that's
right.
what you do, right? You have to play the probabilities.
Right, exactly. And I had a question, because I don't put teenies on this trade. And, so paying up for the put, the trades I've done before, I didn't buy teenies, so I saved all that money. So I get to, if I spend some more to make sure the trade's protected, it makes me feel, I at least have an excuse.
Right.
But
and you guys know,
it's protecting. On the upside, it's easier to. Although we've had some big up moves before, but I always feel that it's a little easier to manage everything on the upside than it is to try and manage it when you're going down.
Right. The characteristics, by the way, guys, of both the Kevlar and the Jeep is that even if we don't end up adjusting soon enough and the market continues to end up running up, our risk to the upside is purposefully been engineered or modeled or designed within the trades so that our losses are going to be, modest. Yes, there are going to be times when we can end up pulling, 2, 3, 4, 5% losses to the upside, maybe even more. But what will end up happening is that it's not like we're going to end up taking a 30% loss. The way, if you get kicked out of the back of your structures and implied volatility ends up spiking and you don't end up acting, those are when you can end up taking, 50% hits to your trade. Now, one of the things that Paul and I end up doing, well, all trade services at capital discussions do, not just the Kevlar or the Jeep, is that we end up talking about our account size. And so I know that when I talk about my account size of $50,000 on my trade, I know that it happens to be in an account that actually has 4 times that capital in it. And if I need to end up reloading the trade next month, I can, and the month after that I can, but I don't ever want to. But I would never trade, 100% of my capital. Paul has, long-term investments. I think that, he and Warren Buffett bought Coca-Cola at the same time.
I think we bought it before.
So I wouldn't doubt it. It's so you do need to end up taking a look at, well, how's this end up playing in my long-term portfolio? I end up putting up the picture for you. Those of you who haven't heard me say this, I think it's absolutely great. What a great quote about trading options, right? You can do all the theory and all the back testing you want, and in theory, okay, there is no difference between theory and practice. When you actually practice trading and you're actually trading live, there is a difference between theory and practice. And so the only way you truly get that practical experience and not the theoretical experience is through the experience of trading through these things. Because I don't care what you think that you're doing when you end up back testing it. When you're sitting in the cockpit seat and it's your money and a significant amount of your money on the line, and you're watching tick by tick, there is so much more emotion and what's going on in your head that what you ended up thinking that you back tested won't be anything like what you'll actually do in reality.
Right.
So, okay, guys, we've been going an hour, and I wanted to end up cutting it short today, so I am going to have to cut it here. Paul, I'd like you to end up making last comments, and while you guys do, would you write any questions? Joe, I did see your question. I'm going to get to it after Paul's done.
Yeah, no, I'm pretty sure. I'm kind of bullish. I don't see. We may have these quick spikes down, but so far, I mean, they're buying the dip faster than it can dip. And I've done some reading, and if you're wondering who's buying this market up here, just do some Googling around to see how much money the corporate world is spending to buy back their stocks versus everybody else. This is pretty much the people that are buying. They're buying their own stock. So I don't see that changing unless we get this big change in the cost of borrowing money. They're going to keep doing it.
Without question, I end up agreeing. One of the things that I just ended up showing you real quick was that this was the market analysis. I can't show you the stuff above because it's where we are on our Vol Vantage trade. But it's everything that we talked about, right? This was the summary of the weekend that I ended up doing. The market environment and the potential for the sell-off is significantly different than it was 1 week ago. Significantly different. It did end up making a lot of sense, okay, with the weak market action that we had for the past few weeks to end up having a more bearish sentiment and be able to end up protecting your downside. But what's happened, okay, during the last week, we're going to end up looking back at this downward redwood channel that I've showed you multiple times. Probably is just a simple time consolidation. And, my fears of the downside after the way the bulls ended up stepping here is significantly lower than we were a week ago. Okay.
We're going to look back at this, what that channel looks like. It's a fond memory of what the market used to do.
Because if you remember I ended up, when I showed you this chart, I'm just going to show it real quick. When I ended up showing you this channel over here, I mentioned that this particular area, I also had downward channels drawn. But when you look at it in context now with what's happened during, since April, you can end up seeing that it looks like one big time consolidation before we moved higher. Okay, when you take a look at this right here, this isn't even half of the downward channel that this was. So it's just going to end up looking like a blip, and so it really doesn't mean anything. For the Kevlar subscribers, I'm going to be adjusting today. I got asked whether morning, noon, or afternoon. What I'll end up doing is that right after this, I am going to be looking at my adjustments. The type of adjustments that we'll be looking will probably be to pick up the entire structures and move them higher. I didn't see anything better this morning when I was looking, so I'll probably end up doing that. I will look at the technical analysis of the market now, which the S&P futures are up 3.5. They had been floating, by the way, all night between -1 and +4, and we're still in that range. So there really isn't any driver for me to have to end up getting things done immediately. I will be looking at the pricing of things and try to end up moving. If things look a little bit weaker, I'll probably only adjust one of our open Kevlars, not two. Okay, so Joe and the other Kevlar subscribers who are on, I will be sending out an update probably within the next hour. And if I don't end up trading within the next hour, I'll wait till after lunch to end up getting the first one off. But I'll end up putting that in the plans and notes. Okay, any other questions? Okay, guys, listen, thank you very much, and I will be talking to you soon. Paul, thanks so much for joining and contributing like you always do. I truly appreciate it, and I'm sure everybody else does also.
Have a great day.
Bye, guys.